George Charkales, financial advisor, and I work with clients, doing many different things. But I wanted to talk about, something that's a pretty big topic right now: super low fixed rates. Dun 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 dun. So, it's an issue for a client's investment portfolios because it's throwing off, historically what you would expect to the expected return, of a client's portfolio, whether prior to retirement or in retirement, because the portion of the money that's placed in fixed income into bonds, because if they're not that super aggressive, is underperforming. Now, when rates go down, the value of those bonds go up. So some of the funds have had good returns over the past, 12 to 18 months, but it's kind of hard to believe that rates will continue to drop much further than where they are right now. So let's take a look, how low rates are. And this is a few days old, but this is the 10-year, this is the US Treasury bonds. And this is kind of where we look to see where rates are trending, because everything kind of follows the Treasury. So, a AAA corporate bond, which is high quality, would be a little higher interest rate for a 5-year period than a Treasury, but, just a tad bit higher. And the current yield, on a 10-year, on a 5-year government bond is, 0.75 is the coupon. Current yield, 0.79, not even 1%. You have to go out a decade, lock up your money for 10 years to just get a little over, 1% a year. And in a client's portfolio, if someone's allocated, like you take a look at this, pie chart, this is pretty typical. You'll see a lot of investors with this type of, portfolio, at least 25% bonds, 75% stock. Some you'll see even higher, 40, 60. So if that 25 to 40% is averaging historically, if you're earning now around 1.3 or 1%, and if there are fees associated with that portfolio, you might be just breaking even on that money, where all of your return is coming from the stock, coming from the stock portion of the portfolio. It's kind of like dead assets, dead money. That money's really not working for you, not working hard for you at least. And so what we've seen is a lot of alternatives, and a lot of people are turning to them. I've done a lot of these. And this next example, you look at this. This is the Franklin Income Fund. Now, this is not a recommendation. I'm not saying you should buy this fund. I'm simply using it as an example because it's kind of interesting. This is a fund that historically has been around 40% bonds, 60% stock. And if you look down here, I don't know if you can see my little cursor here, but equities around 48.7, in that 50% range. Fixed income's 26. Under that, the other portion is convertible bonds. And this is important. This is what I do a lot of: equity linked notes. 23%. Historically, if you go back and look at these funds, you wouldn't see that. You wouldn't see such a big portion of these equity linked notes. These are notes, in a sense, almost like a bond issued by different banks: Goldman Sachs, JP Morgan, HSBC, and they're tied to the equity markets with some type of protection. This is to help beef up, to get more yield, get more interest, get more return into that area, that currently is underperforming. Fixed income, just, buying individual bonds, you're just going out too long and not earning much of a return. So it's kind of interesting that I see this is a huge fund. It's, $72 billion. And like I said, I've followed this fund. I follow many funds, but this one has ticked up quite a bit in its percentage of convertibles and equity linked notes. Now, what are those? And there are a couple different kinds. Now, there are principal protected ones that you have no risk at all. The ones I tend to do around 5-year maturity. So your money is tied up for 5 years in these types of investments. Now, the way it looks is it'll track an index like the S&P 500. The S&P is in blue. So if you put in money and the S&P falls, this is the dot-com bubble, 2000, to 2002, the market got creamed. Here is 08, the market got creamed. You'll notice your account value stays the same. It doesn't go down in those years because it's principal protected. But what's very unique about this investment structure is that down here at the bottom, in between 2002 and 2003, right here, the market started to go up. And when the market goes up, you actually, the value of your investment, on this annual reset appreciates in value. It looks at each individual year in the market. So even though the market is below where you got in at, you actually earned a gain. And they tend to have caps around that 4.5 range. So here you would have made 8 to 9% on your money, even though the market is lower than where you bought in at. I mean, that's kind of unique. Imagine that, earning a return, even though the market is lower than when you bought in. Normally you don't find that in an investment. Another very important factor with these annual reset, when the market tails off and gets creamed, you don't fall with it. The gains you made are locked in. They stay in your portfolio. You have no risk. It's insured. So it's pretty unique. Not only is your principal protected, but the probability of earning a return is greater because it looks at the individual year in the market. And then when the market falls off, you don't have to worry about selling to protect your gain because it's locked in. You can't give back. Every single year, your account has to be either equal to or greater than the prior year. This is great for conservative money or super conservative clients. I have some very old clients that don't like taking risks. And these types of structures are just perfect. They make money averaging in that 4 plus range with zero risk. And there are no fees associated with this. It's a 5-year hold, 5-year lockup. If you don't have 5 years, you probably shouldn't be investing. But this is a great alternative. And you're starting to see all the big money managers starting to work these types of notes into their portfolios to try and help offset the low rates that they're earning on the fixed income. But this annual reset is an incredible way to invest for conservative money or conservative people, and a very short lockup. You can walk away with your money in 5 years. Here's another one that I use quite often too. And this is not 100% principal protected. This example, this is one that has a downside protection, but it's very unique. And the reason I use this is to get a much higher return. These tend to be in that 6 to 7% range. This is great. So the way this works, it looks at the market, say the S&P 500. And if the S&P goes down, it pays out a coupon of say 6%. But what it does, it pays it out when the market is at least flat or greater than when you bought in at. So when the market's down, your principal is intact, but you don't receive a coupon. But say in year 3, the market you're back even, it pays out 3 coupons. And in this example, the investor would have made 21+% on their money. 21+%. And it gets called and you get back your principal. So in this example, this is only a 3-year hold. It was only a 3-year commitment, and the investor made around 21%. And now let's just say the market was down till maturity, the 5-year period, then it'll have some downside protection. We'll absorb some of the downside. So this would be an example of a little more risk, not a lot of risk, but a little more risk with some downside protection. The prior one that I showed you is an example of one little lower return in that 4%, 3 to 4% range, but zero risk, no risk at all. Both of these examples I've given you are around 5-year periods, which fits in great with a client's portfolio because most people are looking at that 5 to 7-year time horizon. So I see my time's almost up. Just wanted you to understand that I'm giving you examples of how these things work. I definitely didn't intend this to be a recommendation for you to go out and buy anything. You should definitely talk to your investment advisor or some professional to help you understand how these work and if they make sense for you. But with that, I will open up the questions.
George, you like these better than bonds, it sounds like.
It's just bonds are, you're not, you made money in bonds because rates went down. So the value of your bonds go up when rates go down. The question you have to ask yourself, how much lower will rates go? You know what I mean? They could, right? But then again, they could also go up. So the money you made when the bond rates went down on your bond portfolio, you could give back as rates go up. So it's not just me, but major portfolio managers managing, $75 billion portfolios are now implementing these. Think about that, $75 billion, and he's got, around 10% invested in these types of instruments. That's a significant shift to these type of investments. And you don't have to be a billionaire to do these. You know, I do these for individual clients, you know, they're available to everyone, you know.
Thank you.
All right.
George,
Well-
what's the entry level to get into that?
Usually $1,000, they're done in $1,000 increments. Yeah, so just rounded $1,000 increments, 1 to whatever, yeah. And they're issued monthly.
All right. Well, if you haven't done a one-to-one with Chris, you definitely, with George rather, you definitely should.